Charlotte, thanks for joining me today. How are you?
I'm very well, thank you. How are you?
Really good, thank you. Do you want to tell me how you got into the industry from the very start, and now obviously you're a protection specialist at Radcliffe and Co. Let's start at the start and let's end up here.
Yeah, of course. So I was just out of university. I was like 23, 24, looking for my first kind of step into the career market. And I started as a sales support, they called it a sales support officer at LV. So I just did life insurance quotes for financial advisors. Worked my way up to being an account manager and then a business development manager there, and had my own panel of financial advisors and mortgage advisors, and promoted the benefits of LV's products to them. From there I moved across to Royal London and became their income protection specialist at Royal London, coaching and giving support to the other sales people, and had my own panel of accounts in the Southwestern Channel Islands. And it was my job there to build up the relationships between Royal London and the financial advisors that I looked after to encourage more life insurance and protection to be sold through business development. And then towards the end of 2019, I decided that actually I wanted to impart my knowledge directly to consumers. So I made the decision to leave the business-to-business world and become a protection advisor, protection specialist, direct to consumer. It was brought on through a significant life event that I experienced in the early part of 2016 when I lost my partner on the day that we exchanged on our property. And although he had life insurance in place, it wasn't set up correctly, and because we were not married, the payment didn't come to me, it went to his next of kin. And as a result, I actually lost my house because I couldn't afford to keep the mortgage by myself. So it came from a part of, I understood the importance of life insurance firsthand, but I also understood, more importantly, the way a policy is set up and structured is even more important. And if it's set up in the incorrect way, it doesn't do what it's designed to do. And as much as I liked training financial advisors around the importance of it, without having experienced that life event themselves, they sometimes didn't really understand the importance of writing a policy into trust or nominating a beneficiary. And it was that decision that made me move from the B2B world to be an advisor myself, so that I can ensure that more policies are set up correctly, and the life insurance that you want, that you put in place for your family, does do what you want it to do, because once you've gone, you can't change how that policy is set up.
And it's really interesting, isn't it? Because a lot of people sell life insurance, and like you said, the policy that your partner had wasn't set up properly. What is the difference between an advisor who sets a life insurance up properly and an advisor who may have set up your partner's policy? Well, how do we determine the differences?
So I think the big difference is that care. It's that how much you care about the outcome rather than setting the policy up
and getting the commission.
Exactly. So my partner used a warehouse, a big, what they call a protection warehouse, where it's normally telephone based, telesales, and they're very heavily targeted to get that sale on the board and that policy written. Once that policy is on risk, they've moved on to the next client. What would have made all the difference to my partner's policy is just somebody taking out that extra little bit of time to ensure that he had the trust documents posted to him, ready to complete. Did he need any help and support in completing those trust documents? And just having that extra conversation with him to make sure that that policy was going to do what he wanted it to do. He said what he wanted it to do, but without that trust document, it would never have happened. And unfortunately, that's where it was missing. What I do as a specialist in a firm where we pride ourselves on building those relationships is that some of our clients have been with us for generations. They trust us, and therefore they need to trust me to do the right thing by them. So by getting to know our clients on a more personal basis and having that much deeper conversation with them and getting to know them personally means that they trust us to do the right thing by them. And I think without that personal relationship, a client can just be seen as a customer, whereas to us, a client is a client, and that's where the specialist and the bespoke advice can come into play much more than being commission-based or targeted around sales.
And is it important, so these policies been set up for 25 years, 30 years, how often would you do a review of your client on the policy? Because maybe some specialists don't do these reviews, the warehouses you referred to, you know, how often should a review be done?
So a review on life insurance doesn't need to be done as regularly as you would review your pensions or investment portfolio. So you would normally review your insurance policies when you've experienced a significant life event. We would contact our clients every 2 to 3 years to see what's changed in that time period, if they've moved house and taken on a bigger mortgage, if their family dynamic has changed, perhaps they've had another child, if they've got a new job or had a salary increase. At that point, all of your protection can be reviewed to make sure it's still going to do what your intentions are for it to be done. Now, the key is for protection is it changes, the premiums will be different according to your age when you take the policy out and according to your health when you take the policy out. So if you're younger and healthier when you take out the policy, you're more likely to have a lower premium. So when you review the policies, as long as the base policy that you set up initially is still fit for purpose, then you can just add to it as you need to go along. And you wouldn't necessarily need to review the entire policy unless it wasn't fit for purpose. So we try to put the basics in place for a long time to the client's retirement age, and then we can put top-up policies in place as their life changes, rather than doing a full review or a full rebroke, which 9 times out of 10 is not going to be beneficial to the client unless there's something wrong with the structure of the policy.
And you see, you've been in the industry for quite a while, and first, twofold question. Number one is, how has the industry from a sales perspective changed from when you first entered? And talk to me about the common conceptions of life insurance with these big large firms that advertise during morning TV, and then you've got these other large firms that are constantly on the phones, and then you have the elite specialists who, you know, have earned their stripes, you could say, in the industry. Talk to me about the conceptions and how the industry's changed.
So I think when I first started out, life insurance was very much badged under all insurance policies. And insurance salespeople, if you like, do have a bit of a negative reputation. Through the promotion of creating better customer outcomes, we've been able to change the perception around life insurance as a need rather than as something you should have. It's something that people need to recognise that it's something that they do need to have, and the reasons behind that. But it's the education piece around the ill health benefits. So when I first started out in the industry 10 plus years ago, income protection, for example, was very rarely spoken about. And that was for 2 main reasons. Lack of education on an advisor's perspective, they didn't really know much about it. And at the time, it could be quite difficult for some people to claim on an income protection policy due to the definitions attached to it. So you might need it to have been severely incapacitated before you could claim on the policy. Providers have taken TCF and treating customers fairly very, very seriously over the last decade, and they're much more transparent in when you can and can't make a claim. So for example, today, if you were to take out an income protection policy today, you would be assessed on your ability to do your own occupation. So if I couldn't be an advisor for whatever reason, I would be able to claim on my policy. And due to accident or illness, I wouldn't be required to go and get another job which is suited to my physical or mental ability. So it means that your consumers have got much more confidence in the market, and therefore they know that their policy is going to protect them the way that they expect it to be protected, whereas say 10 years ago the definitions were a lot more difficult to claim on, and that's where some of the negative connotations with insurance came into play. There's lots of new initiatives over the last couple of years in promoting good customer outcomes, and I'm involved with a group called the Protection Distribution Group, the PDG, and we're a group of about 30 protection specialists from across the UK, and we come together a few times a year to discuss what barriers there are to consumers entering or obtaining insurance policies, and we actually work with the providers directly to make insurance more accessible. So perhaps if you've got underlying medical conditions or unusual occupations, or it's taking a while to get claims paid, we look at all of those factors to make sure actually the underlying reason that people take out a policy is met at point of claim. They've been together for a few years, so it's a relatively new group, But it's really exciting to be part of a group of esteemed professionals, if you like, in that capacity, who are working together. We're not against each other, we're working for each other in promoting better customer outcomes.
So the industry, some people may not know, is lucrative, okay? But what I'd be interested to know is what's the balance between, in general industry, does greed sometimes outweigh the real reason the policies are there for people, and how does that leave you when you then speak to people who may have been approached by one of these individuals or firms that are very sort of sales heavy and advice less?
Yeah, so there is a real balance between giving the best advice and not getting carried away with the amount you can earn in the industry. Like you said, it can be quite lucrative. And when you're working for a firm which put heavy targets on you to sell a certain amount of policies, that's where I believe bad practice comes into play. And I've had clients contact me when they've said they've been approached by a third party to review their life insurance, and they've been recommended something significantly cheaper. Now, when we've looked into it, it's cheaper because some of those benefits have been withdrawn from the contract. So, for example, they might have a life and critical illness policy at the moment, which will pay out should they pass away, but also should they be diagnosed with something like cancer or suffer a heart attack or a stroke. Much, much, much more likely to happen whilst you're of a working age, and therefore the premiums are more expensive than a life-only policy. But when they've come back to me and we've looked to see what the newer advisors proposing to them, which is significantly cheaper, it's a life with terminal illness policy. So it's the terminology can get confusing for a consumer. Critical illness, terminal illness, two very different policies. Terminal illness will pay upon diagnosis of an illness where you've got a limited life expectancy, normally less than 12 months, but a critical illness policy will pay upon diagnosis of a specific illness regardless of life expectancy. And as we know, you can survive much more critical illnesses now with medical treatments available today than you are you're much more likely to survive it than you are to pass away. And it's that's where some of the mistrust, I think, comes in with the industry. When you do a fully advised policy, these policies aren't the cheapest expenditure that you're going to have each month, but they're the most important. So it's really important that a customer or a consumer understands why they've got that policy and what it's actually going to do for them and their family, and they don't just see it as a direct debit. It's very easy for a salesperson, if you like, to get caught up in the commission payments that are payable to an advisor for setting up a policy, because we don't charge any fees for this advice. It is purely on the back of commission if they take out the policy. So if you do come across somebody who is perhaps more target driven, there is going to be extra pressure on them for them to close that sale, because otherwise they won't get paid, or they won't get paid their bonus. From an advice perspective, we're much more concerned about offering the right advice, which is why we're whole of market and completely independent. But more importantly, it's about spending hours with our clients to make sure that they really understand what that direct debit each month is going to do for them when they need it.
Of course. And in terms of your years in the industry, moving on to marketing, how have you seen that change? And talk me through maybe how life insurance has become this common thing in the modern world, but maybe back in the day it wasn't. And how have the insurers brought it to people's attention and consumers' attention?
There's definitely been a shift in general marketing, and we've seen that adverts. We see some of the providers advertise on mainstream TV. Recent months I've seen Legal and General, Aviva, Royal London, all advertise on daytime TV. But we're also seeing more of the intermediaries advertise on TV as well, people like Dead Happy, social media campaigns, so around Polly, which is targeting first-time mums or young mums. So there's definitely much more awareness around life insurance, and the marketing has been much more aimed at directly to the consumer rather than to the intermediary. 10 years ago, there was very little marketing material available to a consumer, or in a consumer's language. It was all aimed at an intermediary such as a mortgage advisor or an IFA. So just by having that slight switch and actually let's talk to consumers directly, I think you're right, there's that greater awareness that life insurance is there for young people as well.
And I think when I see a lot of life insurance advertisement and marketing, it's all surrounding the emotion of fear. Which, as we know, in marketing, you have to target either pains, fears or thrills, and there is a very evident fear when it comes to life insurance. But if you are looking to target a separate demographic, a demographic of maybe the higher value policies that need more education and more time with your clients, how important is educational marketing, and maybe is there a lack of that in the industry where people are being educated through marketing?
Definitely. So still I think there is that gap between what's the message that is put out to market and real expectations. So we quite often see policies from £5 a month. Well, yes, you can get policies from £5 a month, but 9 times out of 10 that's not going to be fit for an individual situation. To take a policy out for a longer duration, i.e. in line with a mortgage term or in line with when you've got financial commitments for, so of a working age, you're talking about covering yourself up to mid-60s, early 70s in terms of an age. Those policies aren't going to be £5 a month as the advertising suggests, because there's a much higher chance that you're going to make a claim in that policy term. A £5 a month policy will normally only take you up to your early 30s, possibly early 40s, because statistically you're less likely to make a claim in that time, hence why the premium's lower. There's also a conception or a misconception, I think, around life insurance. So under life insurance, we all talk about life insurance being a policy which will cover it in the event of loss of life, but underneath that banner, there's many more policies which should be discussed with clients around the loss or the impact of ill health, so critical illness and income protection policies. They require a lot more detailed conversations. The premiums are higher because there's a much higher chance of you being poorly than you are passing away whilst you've got that policy. And it's that education piece, I think, which we still, as an industry, have to work with to get that message out to the masses that you're unlikely to pass away. That's not to say that it's not going to happen, you don't need the cover, but you're much more likely to suffer from an ill health of some kind, which is going to perhaps impact your ability to pay your mortgage or pay your bills or to maintain a lifestyle. Because we all know, especially with the increased cost of living, money coming into your bank account is what's needed to pay for the expenditure leaving your bank account. If you don't have that money coming into your bank account, you're not going to be able to afford to pay those outgoings. And that's where I think as an industry and marketing there needs to be more focus on.
So we know the common marketing channels in life insurance, in insurance in general, typically it's on the phones, typically it might be a post campaign, PMP, phone or phone, or it could be a TV advertisement. How do you generate your leads and what channels really work for you within your demographic?
So I really rely on referral, networking and otherwise. So it's very unusual for somebody to wake up one day and realise that they need to take out a life insurance policy or they need to talk to somebody about critical illness or income protection, because those aren't terms that are generally used in everyday life. So I do rely quite heavily on building up relationships with my trusted referral partners. They're the people like mortgage advisors who are discussing taking on a significant debt and how are you going to maintain that debt, that mortgage. Letting agents, so if a client enters into a tenancy agreement, what fallback, what safeguards they have to maintain the rent payments should they be poorly or should one of them pass away. IFAs or financial advisors that are specialists in their own right, so they specialise in pensions and investments and savings, and they don't stay up to speed with the protection world and the life insurance world. Accountants who are dealing with company directors and business owners and self-employed people on a regular basis can help identify the need for that cover. And other insurance brokers who really don't do what life insurance is about, so private medical specialists or general insurers. So I get pretty much all of my business and all of my clients from trusted referral partners who've had a conversation with a client already and have identified that need and then signposted them to me for full advice.
And would you say that level of channel attracts a certain type of client, and would you typically be insuring a 21-year-old single mother for £14 a month, with one of the big insurers, or do you sort of sit through this channel with maybe someone who has a family of 5 and they have, some liabilities where there would be a genuine need, I guess, for high value cover?
Yeah, so a lot of who I speak to, a typical client, if you like, so somebody I would speak to 3 or 4 times a week would be a first-time buyer or a couple, first-time buyers with or without children, just embarking on that first property process. Now, they've now understood the importance of the insurance, so yeah, their premiums aren't necessarily going to be the £14 a month policies, because they've got big debt to insure, and some of them have got quite big incomes, because to be able to afford a house nowadays, you've got to have significant incomes, and so you get somebody who's more interested in protecting that asset that they've just spent, up to 5, 10 plus years saving towards. We also deal a lot with business owners or clients in their older years, obviously, either wanting to rebroke or review their cover. Is it still fit for purpose? Or business owners to ensure the shareholdings of their company or their key people that they rely on within their business. If you're slightly older, you're more likely to have medical conditions which don't fit the general advice model. They really require specialist underwriting. You've got to do quite a lot of in-depth knowledge to make sure that you are placing that client with the right provider who will cover them for the right premium for their medical conditions. So if we compare the conversation that I might have with some of the kind of warehouse type conversations, it's a very different conversation, because I will spend a lot longer in identifying what specific medical conditions or financial barriers, financial underwriting constraints might have, to then place them with the provider which is best fit for them, rather than the provider that is on the surface looking like the cheapest.
Yeah, it's very much not a one-size-fits-all kind of
Absolutely.
Policy, and it has to be bespoke to get it right. So
Absolutely.
to finish off with, one piece of advice, the most important piece of advice you would give to someone who is looking into life insurance for the first time, regardless of age or circumstance?
The biggest piece of advice I can give is just speak to somebody you trust. Speak to somebody who a friend or family member has already spoken to and can validate that advice for you, and make sure you really understand what it is that you're taking out, understand what risks that you might face and what your policy is going to do to support that. The worst thing you can do is take out an insurance policy because you feel like you have to, and then further down the line not really understanding what it is it does. It's a direct debit which is going to be with you for a long time. It's not like a car insurance premium which renews every year. It's there for 15, 20, 25 plus years. So my biggest piece of advice is always understand what it is you're paying for, but also you're never too young to take out insurance. Premiums are going to be the lowest that they can be when you're younger, and they'll only get more expensive the older you are when you take the policy out.
Brilliant, that's really useful. Thank you for that, Charlotte. Thank you for joining me today. I really appreciate it.
No worries.
Cheers.